Hello everybody and welcome to Green Star Trading with me, Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right, we're back on YouTube and we're having a look at Bitcoin today, but we are doing something a little bit different. We are going to focus on the long term today. I'm getting more and more questions about, is this the peak? Is this the top? Are we going to crash into another bear market soon? Is the bull market over? You know, this is all the last moments of trepidation and fear and worry before the final move. This is the penultimate move, so to speak, we've been going through recently before the final blow off move into the end of the cycle. Now, some people are going to poo-poo this video because I'm using historical data to make future projections. The simple fact of the matter is that's all we can do. It's all we have to go on, and until the information or the cycle or the model we're using is proven to be wrong or has broken, we adjust to take in the new data and we form new ideas. Well, until they're broken, until they're proven wrong, we don't throw the baby out with the bathwater, so we stick with what we've got. Okay, I just wanted to take a moment of your time to talk about the Green Star Trading Patron and why I think you should consider joining. So, one of the things I really want to get across, and has been brought up several times by our members, is this is not a expensive subscription service. Okay, you can sign up for 10 quid a month at tier 2 and you can leave the next month if you want. During that month you will get the weekly updates for the major moving markets of the gold, SPY and Bitcoin. I occasionally change out gold for oil or something, but you get a market update each week. You get access to all of the previous educational content I've ever produced, including the ELLIOTT WAVE series. You get access to a public Discord with multiple channels where you can discuss things with our other members. You get access to live streams where I cover the exact assets you want me to look at. There's a specific channel for you to make those requests. Sometimes these live streams are 2 hours, 3 hours, sometimes even 4 hours long. And that is just for £10 a month. And like I said, you're not obligated to stay. If you want that and a little bit more, you can join for £15 a month, get everything I've previously mentioned, plus a dedicated series called Watchlist, where I look at the specific assets I'm currently interested in and go into great detail in the analysis of those assets. You also get access to the monthly dividend calendar and stock rating system. So I think it's a bargain, guys, and like I said, my whole mission with this channel over the last few years is to just try and help people get their heads into trading, into investing in a way that's affordable, isn't going to break the bank, isn't going to screw anyone over, and just try and push them in the right direction to help them develop their own skills and their own interests. You know, I'm not a guru trying to market £1,000 program or any nonsense like that. So it's totally up to you. There's a link in the description box at the bottom of every video, and if you want to sign up, feel free, but it is the best way to get regular updates, the best way to get access to all of the benefits I just mentioned and to all the extra content that isn't available here on YouTube. So if you do choose to sign up, be aware there is a free option, but this is a nonsense option. It's something that Patreon forces upon all of us creators, and it will give you access to absolutely zip. There are 3 tiers, tier 1, tier 2 and tier 3. Tier 1 is just your opportunity to make a donation directly to Green Star Trading to help me continue my work on YouTube, but you will receive no further benefits after that other than knowing that you're a wonderful person and you have my thanks. If you want to gain something from it, then you should consider joining tier 2 or tier 3, the aforementioned £10 a month or £15 a month. Alright guys, thank you very much for your time. Now let's get back to the video. So on that note, we're looking at here, the green boxes are your bull markets and the red boxes are your bear markets. These are your significant drawdowns. Okay, they're roughly a year in length, 364 here, 364 here, 413 here, projected 357 here, maybe longer, maybe shorter. This is all based off of taking the previous bull markets and bear markets and projecting them forward. 1064 day bull market here, 1064 day bull market here, 1148 day bull market here, 1071 day bull market projected here. Like I said, could be a little bit shorter, could be a little bit longer. But if everything plays out as expected, this is where we're going to peak at the finish line somewhere around October this year. If it doesn't peak there, or significantly before, significantly after, we will throw out this model and we will adjust to new ideas, but there's no reason to abandon it until it's proven incorrect. So that's where I think we are in the cycle. Now we can put in our little seasons here, spring, summer, autumn and winter, and we're just going to get rid of the market cycle for a moment and get rid of these bull market to bear markets, and we can see where we are in autumn. We are now well through summer of this cycle. We are now closing into the final blow off move of autumn, and the biggest question I've been confronted with most recently is or the biggest belief I've seen expressed if the continuation of this 4-year cycle is going to continue is there isn't enough time to make the gains left in this cycle, Tom. We've only got until October or November. I disagree completely, and I'm going to show you why. So a few weeks ago, when a friend of mine was having this exact conversation with me, I sat down with him and the chart. We went over our different charts and stuff and spoke things through, but he was getting quite bearish at the lows here, and I was very bullish at the lows, saying this is just another correction, we're going to rally off to new all-time highs. Okay, and he was saying no, I think we've had 5 waves complete and now we're going to come down lower. Also an Elliottician, but I was much more confident. Now we have swung to an all-time high. So at that moment we drew on the chart this. You are here. So this is where I believe that low was. Now there may be one more to come before we have that blow off move. We can talk about the shorter term count some other time. But this is where we were at that moment, at those lows. You are here. Here's the prior cycle. Now the alternative you could also absolutely include, if you wanted to be fair, you could include this one here, right? Because there is the possibility that we double top and that this is the peak. The difference is the wave count doesn't support it anymore now, and it makes it, and the Elliott wave on the shorter time frame doesn't support it at all. It's not impossible, but I just think it's less likely. But either way, the timing is still relevant. Okay, so you are here, you are here, you are here, you are here. There isn't enough time left to get to the peak. Not with all the gain that's going to be made. Incorrect. Let's have a look at some of these timing from these lows. Okay, so from this low to this peak, we are going to say that was the peak there. We're going to come into the daytime frame to make sure we're being as accurate as we can be here. Right, this is 147 days from the final major swing low of that bull market in autumn to the high. It was 147 days. From this low to this high was 93 days. Okay, from this low to this high was 140 days. What are we projecting out? Well, there isn't enough time to make this final move up. Shall we have a look? So from our current low to the projected completion of the bull market, there's 193 days. Not only do I think that there's enough time to put in all of this price action before the next apparent bear market, I think there's time for another substantial low as well. If all it takes is 93 days in the fastest scenario, 140 odd days in the longer scenario, we've had 193 since then, so we could probably correct one more time and still have enough time to make all of that move. Now, what is all of that move? That's the next question, isn't it? So shall we say we'll put all of these in the You Are Here folder, and then we'll include the amount of gains that was made in that final move. So in this bull market, that final move represented 1,699% gain. That's the last few days of the bull market out of 4 years. Okay, well, 3 years of going up, 1 year of going down. So out of 3 years, that's the last few days of it. The last few months, the last few days. Right. This was the one I called here. You could use this one, though, and that would be perfectly fair. Right, the last final low swing low before, I think we might do something similar to this, where we have a pullback, move up, and another pullback. This represented 1,000%, 10-fold gains, 16-fold gains here, 10-fold gains here. Vast majority of all of the prior 3 years is an irrelevance relative to what happened here. Right, now obviously the COVID period cycle of 21 into 22, or into the highs of 21, I should say 20 into 21, was different. The highs were substantially subdued. We got 140% gain here, significantly smaller, nothing like the 10-fold gains we saw. But the time frame from swing low to swing high was still eminently enough time to do what we needed to do. So we don't know what the gains are going to be. Right, but I would argue we've definitely got time. So if you're freaking out about, oh, there isn't enough time left in this cycle to get all this work done, there's plenty. Right. For those of you who haven't been through these rocket ships before, I've been through this one. It will blow your mind when it happens. You will not be able to deal with it. It would just be unbelievable, the gains that are made in the hours. And it is hours. You know, we're so used to dealing in months at the moment and so used to dealing in weeks that when we get down to these gains in the days, hours and eventually minutes before it's over, it will blow people's minds. Okay, and they just won't understand what's going on, and the chart will go vertical, and it sounds like absolute bull porn, and it could all be wrong, right? It could all be wrong. But since I called the low back in November 22, well, really December 22 I called it, I've been right the whole time. Okay, and continue to be so. The day will come when I'm wrong, but that will likely come when we're ready to roll over into the bear market. And at that point, if I'm calling the top or somewhere near it based off of this model, and then we roll over to a bear market, well, then I guess I'm right again. So we'll see. But either way, I'm just, the main thing I'm dealing with here is the idea that we haven't got enough time. We've got plenty of time. So the finish line's around October this year. Bull markets and bear markets, if they play out, give us that same 4-year cycle. The 4-year cycle, some people associate with the halvings. You can't discount the halvings because they do line up in time, but they're probably not the primary mover they were given the greatest weight for over previous cycles. It is probably more likely just market liquidity, as this has become more and more of the adopted belief, and I don't necessarily argue with it. So whatever it is, short-term debt cycle, long-term debt cycle, equity cycle, ISM business cycle, it's all liquidity, and it seems to be operating across multiple markets on a 4-year cycle. And we can trace this back for a long period of time, not just here in Bitcoin. So if it's working, we stick with it. So there's your market cycle, there's your bull markets, there's your bear markets, there's your seasons, and here's a little you are here marker from that low I was talking about with my friend. Okay, we've since moved on to new all-time highs. Well, we've since moved back to the all-time highs since then, and now we're looking to continue higher. So now that we've covered that, let's move on now and have a look at some other evidence which suggests that we're not done yet. So here's our halving data. Now I know some people are going to poo-poo this and go, well, the halvings aren't relevant. I disagree. I don't think they are the primary mover, but I think the data recorded on the time basis between when they occur and where we end up in each cycle is relevant because it tends to play out pretty accurately each time. So whether it's the main driver is irrelevant, the measurements we're using and the timing it has is relevant, I would argue. So we have the total bull market move from the low of 2011 to the highs of 2013. And we could take the total percentage of it, but when we look at the percentage which is representative of the gain post-halving, so from the day the halving occurred to the peak of the market, we saw 9,517% gain in this bull market. That represented, out of the total move of the bull market from low to high over the 3-year period, 98.96% happened post-halving. Going into the next cycle, from early 15 through to 17 and early 18, 97.44% of the total price move from low to high occurred post halving. Now I'm not saying it was a gain of 97%, it was a gain of 2,875%. I'm saying out of the entire move, 97.4% of the entire move occurred after the halving. If we look at the last cycle, 91.6% of the total price move occurred post-halving. Alright, now if we look at the current cycle, so far, the total so far, 54% of the total price move from the low to the current high has occurred post-halving. More than half, but nowhere near the 91%, nowhere near the 97%, nowhere near the 98%. Now you could be pessimistic and say that's all we're getting. Post-halving was a 54% move, which, and I'm not saying it's 54%, you know what I'm saying. The total swing from the low of 2022 through to the highs we've had recently, represents the move. Post-halving represented 54% of all that move. We're used to it representing 90 plus. But even if it was 75, 80, 85, 88%, we've still got a lot of work to do. So when we look at our expectations for the gains post-halving, when we look at our expectation for the timing, okay, and where we think we're going to finish, the previous gains we've seen in those autumn periods, where we are currently in the cycle, and how much gain there is potentially to be made, there's loads of room to make that 91% or 94% or whatever percent of the total move post-halving. There's enough time to do it as well. So in other words, beating you over the head with it, and this is not intended to be a lecture at all, it is just simply pointing out what we've already observed multiple times before. We have everything on our side still. I know it's been difficult. You know, it's difficult every cycle. I've been trading for a long time now, and it's difficult in equities, it's difficult in Bitcoin, it's difficult wherever you are. There are always bearish voices. I spoke about this in my recent stock market video. If you haven't seen it on my channel, go and watch it, about the environment of fear. We live in a world which always wants to talk about the next great disaster, the next great crash, wants to scare you out of every position you ever have the courage to enter. The trick is to wash out the noise, to cover your ears, look at the chart, look at the trend, and stick with what's working for as long as you can. Okay, don't get frightened out of your position. Don't get frightened out of your trade. Right, this is what they got. This is what they want, and we mustn't give it to them. Okay, so we've spoken about the length of these bear markets. These bull markets and these bear markets. We've looked at where we are in the cycle. We've looked at our finish line. We've looked at our potential price gain. And we've come to the conclusion that, yes, there is sufficient time left. In fact, there's more time left between now and our proposed ending of this cycle than there was in the prior swing lows of the final autumn move before the highs of the prior cycles. So stop freaking out. We've got time left, and we've got enough time to do a lot of work. So if you're new and you just put your toe into Bitcoin for the first time and spot bought your first pieces of first few Satoshis, you've probably still got some nice gains left in this cycle. In fact, if the more aggressive prior cycles play out, the 2015, 2017 cycles play out, 13 and 17 cycles, play out, you will have the majority of the gains of the entire bull market still ahead of you. Brilliant, right? But the day is going to come when the next bear market arrives. We're expecting it to trigger sometime around later this year. And then you're going to have a nasty drawdown to sit through, right? But it's an opportunity. I've spoken about this multiple times on the channel before. I spoke about it recently in the stock market about how fear takes people out of the opportunities. They miss the opportunity because they listen to the fear. When we go through this next bear market, corrections we've seen before of 77%, 84%, 86%, 93%, everyone will be calling Bitcoin dead. The bears will be wanking themselves off as though they're some kind of great genius. They're not. They're just finally like the stopped clock is right twice a day. It's finally their turn to think they're clever. But they're only going to think it for a while. 365 days if the averages play out. And then it's over with, and the buying opportunities here again. Don't despair. If you buy the top, some of you will. You may be watching this video retrospectively going through a channel sat there in the bear market right now. Many months ago this was made, thinking, oh, I can't believe it, I bought the top. Don't worry, mate. I've been there. I've done it. Been trading a long time, and I've been there, and I've done it. You want to know when I last did it in crypto, how ignorant and how naive I was when I came into this space? I've been trading equities for over a decade, and I still bought the fucking highs in 2017, and I rode this bitch all the way down 84%. Okay, yes, I had the luxury of getting into the markets in 2015, but I got carried away. Why? Because I'm human, and the volatility of this asset class I was not familiar with. I was not trained on it. I did not appreciate how insane it could be. I have found out how insane it could be, and now I'm in my third rodeo, and I'm looking forward, believe me, I'm looking forward to the next bear market. Bring it on. So that's what I mean. Don't despair. It's going to be over within a year normally, and it will give you a serious discount, but it won't be as severe or as big a discount as prior discounts, but you will still hear all the bullshit. Bitcoin's dead, Bitcoin's gone, never going to work, la-di-da. The bears, the stop clocks amongst us will finally be right again, but only for a short while. Take advantage of it. Now, I'm going to get a little bit sage on you now and a little bit preachy. I'm not an old man, not by any means. I'm just further along in my adult story arc than many of you are. Got the wife, got the kids, got all that stuff. And I'm not making assumptions, I'm going on data. When I look at my YouTube analytics data, two very obvious things have come to the fore. One, you're all male, you're all men, and young men, with the exception of a handful of women, but it's basically a sausage fest in here. Not a surprise, high risk on environments, trading, la-di-da. It attracts more men than it does women because men are risk on, and younger men are more risk on than older men. Okay, it's just a way of the world. It's a way of our species. So when I look at those demographics and I look at those analytics, I see a lot of young men. Significantly younger than me, and I'm not old. Okay? So why am I saying this? I don't want to sound like some smart aleck or whatever. I'm genuinely trying to help. A year in your life, 365 days in your life at your age now, is nothing. Right? It may feel like a long time. Certainly doesn't to me now at my age. It feels like I could barely get 3 thoughts ahead in a line in the space of a year. But either way, my point being is, this is the opportunity. As I spoke about in the stock market in my latest video about getting knocked out because of the fear, this is the opportunity. Invest long term. Stop trying to make $1 million overnight. Stop trying to make money fast. You've got 5, 10, 15, 20, 25 years to make millions and more slow. Do that. Don't give up your day job. Keep your income. Increase your income as much as you humanly can. And leverage your income not by borrowing and leveraging as in trading, but by investing in your future. Okay, Bitcoin will give you the opportunity to do that. The equities market has continually given everybody the opportunity to do that for centuries. If you were to take the S&P 500 and lay the ISM index over it, lay the consumer surveys of the University of Michigan over it, lay the M2 money supply over it, lay the PCC, lay the VIX, put all of that over the SPY or the SPX, one thing you will see: every calamity, every disaster, every sell-off, every bear market was a buying opportunity. It was never the end. It was always just another dip to buy. The problem is time frame. If you're thinking minute chart, 5-minute chart, hour chart, and you're not thinking week chart, month chart within the broader trend, you will fuck yourself up chasing volatility. Don't chase volatility. We love volatility as traders, don't get me wrong. If you're trading and that's your intention, and your intention is to have a trading account and an investing account, I'd ensure I would suggest, encourage you to have both. Volatility is what you need to make money over the short term, right? Consistency is what you need to make money over the long term. You need long-term exposure if you're going to make long-term gains. You can't be in and out every 5 minutes, right? Otherwise, you'll get nowhere in the next 10 years, 20 years, right? My God, that was a lecture again. I can't help myself lately, can I? I just sound like a fucking absolutely boring old bugger going on telling everybody what to do. But like I said, I'm still a spring chicken in my mind. I've still got plenty of years left in this market to make a lot of money. And I'm looking forward to the next bear market. So don't despair. It will be over briefly and it will be a wonderful opportunity. It has been more stressful for me as someone who believes in what's going on here, going through the bull market than the bear markets. Reason being is everything I believe, everything I projected, everything I pointed out along this journey has been in constant question the whole time by people who don't believe it. I don't have to care about what they think, and I don't, to be honest, but it still gets to you. Still gets to you. It's difficult to stay the course, that's my point, when there are so many dissenting voices around. But it's going to be a lot easier if you buy it at a 70% discount than when you buy the all-time high. I can guarantee you that. So there you go. Here endeth the rather long lecture about bull markets, bear markets, cycles, and the rest of it. So shall we zoom in, not too much though, on the long-term counts and the way we can look at how this thing's going to play out. So let's do that. Right then, so now a long-term view of the Elliott wave count. So Supercycle Wave 2 bottomed in January 2015. Cycle Wave 2 bottomed in December 18. Primary Wave 2 bottomed in November 2022. If we take a original pitchfork and place the starting point of a pitchfork on the bottom of the cycle wave 2, which is the beginning of primary wave 1, move to the swing high of primary 1 and the swing low of primary 2 and project forward in time, we find a pitchfork projecting the wave expectant wave 3 at primary degree. And as we move along inside of that pitchfork, we come back to the low of it, we test the low of it, and we continue a trend of higher highs and higher lows. Now, the typical target from a geometry point of view for the 1-2 swing to find the wave 3 is the median line. Now, when is the question, right? We have a time frame based on our projections, based on 4-year cycles, previous bull markets, bear markets. So we could lock that in and say roughly there. Now, I've done that on the Patreon video. You could do it for yourself now. You don't need me to do it. But either way, I've done that on a separate video a few months back for my patrons, talking about those targets, those potential price targets. I don't want to get into that today. Either way, we are going to likely place another wave 2 at minuet degree. It may even be in now, or we may come a little deeper, and then we will progress into minuet 3, of minute 3, of minor 3, intermediate 3, of primary 3, of cycle 3, of super cycle 3, within this massive multi-decade bull market. That's where I think we are in the primary count. Now, if we're not there in the primary count, we have some alternatives. So the alternate idea, this one, fifth wave extension, is that we are actually further along than I thought we are, and we're not going to do 1 2 1 2 1 2. We're going to do 4 waves complete, and now in the fifth. 1 2 3 4. Now this is the fifth wave, and the fifth is going to be an extension of 1 2 3 4 5 minor degrees to complete intermediate 5, and we're going to have a blow off fifth. Relatively common in crypto to see blow off final moves. This would be my alternate, my favourite idea after the primary. Okay, we can see where our exponential moving average is here on the daily time frame. Just a quick note of that we've come through the 250, through the 250, through the 250. These larger wave degree corrections are synonymous with breaking the 250 exponential moving average, but also synonymous with bears becoming their most stupid. When we reach these lows, they become their most double down bearish state they can be in, and that normally marks the low. This is why we use the fear and greed index from crypto to help us make these, to identify these lows, right? But this would be my favourite alternate. What about a bearish idea? Well, all of the bearish ideas all the way up to the recent highs have been wrong. So the best idea I can think of is this, that we've had 5 waves up. Right? This was a move into a low. This will be a move into a high. It may expand further. It may already be done. It will then come down in 5s to get the wave 2 at intermediate degree before progressing higher in the wave 3. This is 1 and 2 at primary as we discovered. This will now be 1 and 2 at intermediate, and instead of this being the 1 2 at intermediate, we'll get a larger structure, another bear market. Now in my opinion, if this were to play out, that would break the 4-year cycle, as I don't see this correction being sufficient in time to comprise a bear market, based on the idea that it would have finished the bullish phase so much sooner, much earlier than expected. So, in other words, the correction would be larger than I would expect given the shortness of the bullish phase. But if we are moving into smaller wave degrees, the cycle could adapt in that way. We won't know until it's all done and over with. But once it is all done and over with, we can include that data and make adjustments for being in this smaller wave degree, intermediate degree, and move from there. But like I said, don't throw out the baby with the bathwater. Don't throw away the model until it's proven broken. This would be my bearish alternate that we've already topped, and we're going to do something like this, like a flat pattern. Now it's not counting like one on the smaller term, on the smaller time frame at the moment. It genuinely isn't. So I think this is very low probability. My primary is still considered the highest probability, followed by the idea of the fifth wave extension being the next. And that's the larger wave degree. Correct. That's the larger wave degree Elliott wave count. Okay, so now we're going to zoom into the much smaller time frame. So the chart we were just looking at on the BLX showed you my primary count from the lows of from all the way back, but we saw the 1-2-1-2-1-2 extension from the lows of November 2022. This is what we're focusing on here. 1-2 intermediate degree, 1-2 minor degree, 1-2 minute degree, and now working on 1-2 minute degree. Obviously it's a real mess in here. We're going to come in and tidy it up. So I'm going to come all the way down to the hour chart, and I'm going to zoom in to this lot here, and we're going to do what we can. So I put an update out for my patrons with the weekly update on the SPY, gold and Bitcoin. I do this every week for my patrons, and that goes up on the Discord and on the Patreon as well. You can always get access to that. But we spoke about the possibilities here. Now things have tidied up, things have cleaned up since I spoke about that, and one of the options I put up was this orange count. I think that's the correct one now, so I'm going to go ahead and label that as primary. We'll sort that out in a moment. But either way, we came up off of the low in April in a 5-wave move. 1, 2, 3, 4, extended fifth to find minuet wave 1. We've come back in a zigzag so far, which could have been, or a double zigzag, to find the lows of wave 2, except this has not progressed as expected for an impulse. This has moved as a 3-wave move, and therefore I'm going to move the wave 2 over to here and suggest that we're going to get lower targets within this corrective channel. Now this could still change. This is the best I've got to go on. We are dealing with small time frames here. The count gets more and more volatile the smaller the time frame. So we're just going to come in and make sure that all of the locks are off, and we're just going to delete all of these unnecessaries. We can now change this to invalidation, flat old invalidation. We're going to delete that. We're going to change this to a micro ABC. We're going to change this to a subminuet WXY, and we're going to adjust this to be a ABC, because I think it's going to have a better fit. So we can go A to here, B to here, C to here at micro. This gives us a subminuet W. So we've got an A, B, C. It's not an impulse down in the C wave. It is an expanding diag, I reckon. It would look like this. So we would come down in here. 1, 2, 3, 4, and 5. This is submicro at that point, and we just need to check the length of the 5 relative to the 3. The 5 is longer, so it's a legal count. So the 4 is bigger than the 2, the 3 is longer than the 1, the 5 is longer than the 3. That's a expanding ending diagonal. A, B, ending diagonal in the C gives us a W. A, B, C up into the X. This gives us a zigzag. The way I would express this zigzag over the shorter term, probably looking at it be a diagonal for the A. Very brief B, touching back on support, C wave up. From here we are now moving down in the X wave. Exactly how we're going to do that, we're just going to have to wait and see. We're on a smaller time frame. The one thing I can't really make this work as an impulse. Just doesn't work. But it could work as a zigzag into a 1, so that now changes things again. So all I'm going to do is put a 1 up here and a potential 2, 3, 4, and 5. This would likely be micro or subminuet degree, and I'm going to put this in orange. So to sum up, we came up to a wave 1 in the high of May, 23rd of May roundabout. We came down in 3 waves into a W. We've come back up into an X wave. This is a zigzag here, this is a zigzag here, and now we're expecting another zigzag lower to find minuet wave 2. It looks like, unless we breach that 38.2, the green line here, and go into the target zone, it looks like it's going to be a very shallow correction. It was already very shallow, but we'll wait and see. We'll wait and see. Now, if for whatever reason it goes up to here, it comes back, and then it moves higher, we can use the orange count, and this was A, B, C into 1, and we can now draw this out as a diagonal. What kind of diagonal? Fuck knows. We'll only know once it's most of the way to being done. Alright, but either way, it's either A, B, C, X, and now we come lower to a swing low, below the lows of Thursday the 5th of June, or if we swing higher, then it's A, B, C into 1. And this could be a smaller wave 1 into 2 within minuet 3. Okay, and that's the best I've got for you at the moment. So really all we're looking for is if we move above 111,986, we invalidate this corrective channel, we invalidate this corrective count, we are already done, and it was more likely ABC 1, 2, and now we're progressing into 3. If we breach the lows of the of 5th of June, then we will be looking for a low to come in. We will be looking for a new low, a 3-wave move complete within the channel. So you can go A, B, C. So what we'll do is we'll come off of log, make sure we're off of log, and we'll put a projection in. We'll go W wave, X wave, right at the edge of the channel here. If things were to play out perfectly, we would get a lower low, we would finish the channel, it would be extremely shallow. That would be the Y wave in, that would be the 2 in. From here we'd be looking for standard trade setup, STS off of here, 5 up, 3 back. There's your entry point to go long if you're trading shorter term. And that's how I see the shorter term at the moment. So okay then, one final thing to touch on before we go. If you don't believe anything I've said about the 4-year cycle, if you don't believe anything I've said about bull markets, bear markets, if you don't believe anything I've said about Elliott wave, you don't believe anything I've said about halvings or anything like that, you think it's all nonsense and you don't believe in any of it, you could at least try and believe in this. This is M2 global money supply offset by 70 days. Now let's give Raoul Pal and Real Vision some credit here. He has been going on about it probably the longest and is a big macro thinker. I'm not a follower of his channel. I'm not subscribed to Real Vision. I'm not shilling it. Please don't believe that. I am genuinely not. But I have it has been brought to my attention by multiple members and by multiple people now that this has been covered most frequently, most often, and his charts shared most often on social media. So if they've done the research, fair enough, given the benefit of the doubt. This M2 indicator, however, was supplied by one of our own members, to which we're very thankful for because it comes with this offset ability. Gave us a script to install it and use it on TradingView here. So if you don't believe in anything else I've said, you can believe in this. Doesn't mean it's 100% right, but it's pretty bloody reliable. For as long as money is being printed into existence, for as long as more money is in circulation on the balance sheets of the major banks, not necessarily the Fed at the moment, that will change given time, but generally global M2 money supply, along with the weakening dollar which contributes towards this, is increasing, and this is a massive driver for Bitcoin. A massive driver for Bitcoin. So if everything I've said hasn't convinced you, I hope this does. Like I said, it's not a guarantee that it's right, but what more is there to go on? We've covered as much as we possibly can. So I'm going to leave it there, guys, and we're going to call it a day. We've done a lot here on Bitcoin today. So if you're new to the channel and you like what you've seen, please subscribe, smash the like, hit the little bell notification icon to remain informed of future video releases. And if you're interested in learning any of this stuff for yourself, especially the Elliott wave stuff, there's a series you can follow on my Patreon which will teach it to you. There's loads of other resources there available which I already mentioned in the advert at the start of this video. Go ahead, click on the link in the description box below and sign up today. Take care of yourselves, guys. I'll be back with you as soon as I can. All the best. Bye bye.